समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉपअप करा ले। दिस इज द राइट टाइम।
क्या? समझ में नहीं आया।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले। दिस इज द राइट टाइम।
अब समझा।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to The Print. This is Bidisha and you're watching Economics. Today's question is one that touches every household in India. What happens to a nation's economic future when its middle class stops investing productively? That is not a rhetorical question. There is hard data behind it. There are specific policy decisions behind it. And there is a very clear path forward if the right lessons are drawn from 20 years of capital gains taxation in India. Today's explainer walks through the analysis, the concepts, the charts, the numbers, and most importantly, what a corrected policy framework could look like. 3 charts will anchor this conversation, all data sourced from primary government and regulatory sources, the RBI Handbook of Statistics on the Indian Economy, the AMFI Annual Report for fiscal year 2025, and the Central Board of Direct Taxes Cost Inflation Index notified annually by the Government of India. Let us begin with the most important concept in this entire discussion. Before the data, 3 concepts need to be on the table. They sound technical, but they are not really technical. Concept 1. Capital gains tax. When an asset is sold, shares, a mutual fund, property, for more than it was purchased for, the profit is called a capital gain. The government taxes that profit. That is the capital gains tax. Nothing more complicated than that. Concept 2. Short term versus long term. How long the asset was held before selling determines the tax rate. Hold for less than 12 months, short-term gain, higher tax rate. Hold for more than 12 months, long-term gain, lower tax rate. The logic is sound and widely accepted across economies. Reward patience, encourage long-term thinking. They do not treat a decade-long investor the same way you treat a day trader. The question this analysis asks is, has India actually honored that principle in practice? Before we get to that, we'll understand what is concept 3, indexation. Now, this is the most important one. Indexation is the government's official recognition that inflation exists and that it erodes the real value of money over time. Here is what that means practically. Suppose rupees 10 lakh is invested today. 10 years from now, because of inflation, because everything from groceries to school fees costs more, that same rupees 10 lakh in today's money would need to be rupees 15 lakh just to have equivalent purchasing power. So if that investment is sold for rupees 18 lakh, the real gain is not rupees 8 lakh. It is rupees 18 lakh minus rupees 15 lakh, so therefore it would just be rupees 3 lakhs. Indexation said, only the real gain gets taxed, not inflation, not the simple passage of time. The government publishes a number every single year called the Cost Inflation Index, the CII. This is notified by the Central Board of Direct Taxes. It is the official government acknowledged measure of how much prices have risen since the base year of 2001. It exists for precisely this purpose, to ensure that investors are not taxed on inflation as though it were profit. Understanding what happened to indexation is central to understanding exactly why middle-class investment behavior in India has shifted so dramatically over the last decade. Now to the data. Starting with equity. This is the equity tax ratchet chart on your screen. 4 time periods, tax rates on long-term and short-term equity gains, and the bars move in only one direction across 20 years, upward. Here is what each period represents. Before 2004, long-term capital gains on listed equity had zero tax. The policy signal to the middle class was unambiguous. Invest in enterprises, take that risk, participate in India's growth. The reward for patience was a zero tax bill on long-term gains. That was the compact between the government and the saver. 2004, the Securities Transactions Tax, STT, was introduced. In plain language, a small tax is levied on every share transaction. Every buy, every sell, regardless of whether a profit is made or a loss is incurred, the toll booth analogy is quite useful here. Every car pays the toll whether the journey was profitable or not. Whether the destination was reached or not, in isolation, STT was not unreasonable. It was a simple, compliance-friendly mechanism. But it embedded an important principle. Financial market participation had become a revenue source for the government, independent of investor outcomes. STT has remained with us every year since 2018. For 14 years after the Securities Transaction Tax was introduced, one comfort remained for equity investors. It was that long-term capital gains were still tax-free. Hold for more than 12 months and the gains belonged entirely to the investor. However, Budget 2018 changed that. Long-term capital gains tax, or LTCG, was reintroduced at 10% on gains above rupees 1 lakh after 14 years of exemption. A grandfathering clause protected gains accrued up to January 31st, 2018, but from that point forward, patient long-term equity investing carried a tax bill. Now comes July 2024. Both rates revised upward, long-term gains 12.5%, short-term gains 20%, indexation benefits removed from most asset classes simultaneously. This chart tells the story without any editorializing. The ratchet moved, it has not moved back since. Equity is just one part of this story. The debt mutual fund narrative is, if anything, way more instructive because the consequences are precisely measurable in the data. Before we get to the data, let us first understand what is in fact a debt mutual fund. It is a fund that pools household savings and invests in fixed income instruments, be it government bonds, corporate bonds, treasury bills, lower risk than equity, steady, predictable returns, ideal for the conservative middle class investor. The person who wants returns better than a fixed deposit but without the full volatility of stock markets. Before April 2023, debt funds offered a genuinely compelling proposition. Hold for more than 3 years, gains were treated as long-term capital gains taxed at 20% with the indexation benefit applied. Real returns were taxed, inflation was not. Now, this made debt funds a meaningful alternative to bank fixed deposits, and critically, it encouraged household savings to flow into bond markets, deepening India's fixed income ecosystem. The Finance Act of 2023 changed this through a single legislative amendment, Section 50AA of the Income Tax Act. From April 1, 2023, all gains from debt funds purchased after that date are taxed at the investor's income slab rate, regardless of the holding period. 1 year slab rate, 5 years slab rate, 10 years of patient holding, still slab rate. No indexation, no distinction between short-term and long-term, no reward for patience. For an investor in the 30% tax bracket, and millions of urban salaried professionals are, that means 30% on every rupee of gain. The same rate as a bank fixed deposit. But a fixed deposit carries no market risk. A debt fund does. The tax treatment became identical. The risk profile, however, did not. The rational response, therefore, from investors was entirely predictable. This is the debt fund net flows chart you see on your screen. The primary source data for this is the AMFI annual report fiscal year 2025. In 2021, you see net inflows of rupees 2.31 lakh crore, investors putting money in confidently. In 2022, outflows begin. Rupees 0.68 lakh crore leaves as uncertainty around the tax regime builds. And in 2023, the year Finance Act 2023 takes effect, rupees 1.84 lakh crore was withdrawn, the single worst year of outflows on record. And in 2024, outflows continue, another rupees 0.23 lakh crore gone. 3 consecutive years of net outflows, rupees 2.75 lakh crore in total, drained from India's debt mutual fund industry. This is not panic selling. This is not market volatility. This is a calm, rational, collective decision by millions of investors that the risk-reward equation no longer made sense. The recovery was visible in 2025. Net inflows of rupees 1.38 lakh crore returning. However, it did not come from any policy reversal, but from the RBI cutting the repo rate to 6.25% in February 2025. Interest rate movements made debt attractive again despite unchanged tax treatment. The underlying policy equation had not improved, external conditions had simply shifted. Now, we are going to make this even more concrete at the level of one household. Consider a school teacher in Pune. In 2013, following the advice of financial advisors, government campaigns, and the mutual fund industry, she invested rupees 10 lakh of carefully saved money into a debt mutual fund. She held it for 10 years. In 2023, she sold it for 20 lakh. On paper, the investment doubled. But in reality, the picture is more complicated. The government's own cost inflation index gives us the precise numbers. CII in FY 2013-14 was 220. However, the cost inflation index in 2023-24 was 348. The inflation adjusted cost of her original investment works out to be rupees 15.82 lakh. Her real gain, the amount by which her wealth genuinely increased in purchasing power terms, was in fact rupees 4.18 lakh. Now this chart on your screen makes that comparison visible. Under the law as it stood when she invested, tax on the real gain of rupees 4.18 lakh at 20%, therefore the total tax payable was rupees 83,636. Under the Finance Act 2023, tax on the full nominal gain of rupees 10 lakh at 30% slab rate, total tax payable, was rupees 3 lakh. The difference, rupees 2,16,364, is not a tax on profit. It is a tax on inflation. On the simple fact that prices rose while she waited. The shaded portion in the chart, that is the number that exactly matters. That is what the removal of indexation means at the household level, not in theory, in rupees. Multiply that school teacher by millions of households now, and the macroeconomic picture comes into focus. According to the RBI Handbook of Statistics on the Indian economy, gross household financial savings as a share of GDP fell from 11% in 2021 to 5.3% in 2024, roughly halved in 3 years. As of the fiscal year 2024, Indian households held 71.5% of their savings in physical assets, gold, real estate, land. Only 28.5% in financial assets of any kind were saved. Of that 28.5%, a mere 8.4% found its way into mutual funds. India's mutual fund AUM to GDP ratio stands at 19.9%. In developed markets, the United States, the United Kingdom, and even Australia, that ratio exceeds 100%. Every percentage point of that gap represents capital sitting in gold and concrete, not funding enterprises, not deepening bond markets, not even compounding into retirement security for the families that saved it. There is a well-established concept in public finance called the tax elasticity of savings. Basically, how sensitively households adjust their saving and investment behavior in response to changes in expected after-tax returns. The evidence from India is clear. Price savers out of debt funds, they return to fixed deposits. Remove indexation, gold becomes relatively more attractive because gold has never required a capital gains return to be filed. Make equity gains more expensive, the safety of the bank branch starts looking way more appealing. The data on household savings and physical asset allocation is not a mystery. It is the entirely predictable outcome of a tax structure that progressively reduced the after-tax return on productive financial investment. This is not a paradox, it is just cause and effect. And the stakes of getting this right have never been higher. In a global environment characterized by conflict in West Asia, uncertainty around US interest rates, and disruption in international trade, foreign institutional capital has demonstrated repeatedly that it can exit Indian markets very quickly. In volatile periods, FII outflows can move markets by several percentage points in days. The structural answer to that vulnerability is not to restrict foreign capital. It is to build a deeper, broader domestic investor base. A nation where household savings flow consistently into equity and bond markets is a nation far less exposed to the volatility of foreign capital flows. India has the savings, it has the households, it has one of the largest and youngest working populations in the world. The savings dividend is there to be unlocked. What is required is a tax framework that makes unlocking it rational for the saver. So, what does a corrected framework look like? The answers are not complicated. They do not require new institutions or sweeping legislation. 3 targeted changes would materially shift the equation. First, restore meaningful indexation for long-term investors. If a household saves and invests for a decade, the tax system should recognize the difference between real gains and nominal gains. The cost inflation index already exists for this purpose. Reinstating its application to long-term capital gains for both equity and debt would immediately restore the incentive to hold. Second, rationalize debt fund taxation. Debt funds and fixed deposits are not the same instrument. One carries market risk, one does not. A tax system that treats them identically removes the rational incentive to choose the instrument that actually deepens India's bond markets and funds productive enterprise. Restoring a concessional long-term rate for debt funds, even without full indexation, would meaningfully shift investor behavior. Third, think cumulatively, not in isolation. Each individual capital gains change, the STT, the LTCG tax, the dividend tax, the slab rate treatment of bonds, may have been defensible on its own terms. But fiscal policy needs to account for cumulative friction. The middle class saver is not encountering one of these changes. They are encountering all of them simultaneously. A periodic cumulative impact assessment of capital gains policy measuring the combined burden on the retail investor would be a valuable addition to the budget process. Now, none of this is about reducing the government's revenue. It is about recognizing that the after-tax return on productive investment is a policy variable and that it has been moving in the wrong direction for long enough that the behavioral consequences are now visible in the data. The next budget has an opportunity. India's household savings are large. Its investor base is growing. The AMFI data shows that mutual fund folios crossed 23 crore in FY 2025, up 32% in a single year. So the appetite is clearly there. The direction of travel in terms of retail participation is also encouraging. What is needed now is a tax framework that sustains that momentum rather than working against it. 20 years of incremental policy decisions have produced a measurable outcome. The good news, and this is genuinely good news, is that incremental policy decisions can also reverse it. The school teacher in Pune saved carefully and invested patiently. Millions of households like hers are making investment decisions right now about whether to put money into a debt fund or a fixed deposit, into equity or gold, into financial assets or the physical ones. The next budget can be the one that gets that decision right. Thank you for watching.